Hello everyone, thanks for checking out my video. It's another option video for beginners. In this video, I will share 3 rare hacks or tips or tricks or secrets, whichever you want to call it, of options wheel strategy that can help to increase your win rate and profits. Personally, I think, okay, correct me if I am wrong, what I am going to share here are less known and less talked about by other people. So if you found others sharing what I am sharing here, do comment down below. Anyway, these few hacks are something that I only discovered after trading options wheel strategy for a while. Basically, it's learning through my very own personal experience. Unfortunately, these are things that you probably won't know without trying, and things that I wish I knew earlier or someone had shared with me before I started my options wheel trading journey. Therefore, I am going to share them with you for free so that you can pick them up before you start your options wheel trading journey. Or if you have just started out or if you are still a beginner, I think this video could still be useful. Well, I hope it will be. Most importantly, do watch till the end because the last hack is something that probably no one has talked about, at least not that I know of. Alright, without further ado, let's get things started. Okay, the first hack that people rarely talk about is the selection of stock. Alright, in case you think I'm kidding you, how is this a rare hack, right? Hang on, I know if you just do a search on Google or YouTube, you will be able to find many websites or videos telling you that selecting a fundamentally strong company is important when trading the options wheel strategy. In fact, I actually mentioned this in my previous video on some basic tips and tricks of options wheel strategy. So am I repeating myself? Not really, there are some nuances to it. Alright, just a quick recap, stock selection is important because when you select a good company, even if you get assigned after selling cash secured put, you know the company will not crash too much. And even if it does crash, it will likely recover faster than others. Look at Apple, Microsoft, Nvidia, Google, etc. All these solid companies have recovered from their COVID low and 2022's bear market to all-time high. And when the stock price recover, you will be able to sell covered calls at the original strike price that you were assigned with or even higher and get some decent premiums, thus completing the options wheel strategy. Alright, so here's the nuance. When you're doing options wheel strategy, very few people out there will tell you to do it on good companies that you do not mind allowing the shares to get caught away. I repeat, shares that you do not mind allowing them to get caught away. Okay, what does this mean? Let me give you an example from my personal experience. I have been doing options wheel strategy on Bank of America and Google. For Bank of America, there was this cash secure put which was assigned to me on 30th October 2023. The strike price was $26. With the assignment of this 100 shares, I immediately sold a covered call when the market opened, with the same $26 strike price. The expiration date was 8 December 2023. Feel free to pause here to check out the screenshots and details on the right. Soon after I sold the contract, the trade was very deep in the money as Bank of America rallied about 20% in the next 1 month. At that point, I knew my contract has a high chance of getting assigned early, which means the 100 shares of Bank of America could be caught away anytime before the expiration date. So, if I had wanted to keep these 100 shares of Bank of America, I would have to roll the contract to prevent the shares from getting caught away. But because I was okay to let go of these shares, I did nothing. And true enough, before we even hit the expiration date of 8 December 2023, my contract was assigned early on 30th November 2023. In other words, I was forced to sell these 100 shares of Bank of America away at $26 per share. There is no capital gain for me, but I did earn some premiums from selling the cash secure put and covered call. Okay, moving on to Google. For Google, I have to trace it all the way back to 3rd October 2022 when I was assigned with 100 shares of Google through a cash secured put. The strike price was $100. With these 100 shares, I happily went on to sell a few covered calls to milk some premiums. But unfortunately or fortunately, the bear market ended in 2023. Basically, from January 2023 till now, Google has rallied more than 80%. So during this period, my cover costs were always in the money. Which means whenever the expiration dates were nearing, I had to roll the contract to prevent these 100 Google shares from getting caught away. No hiding of my trades. Look at this screenshot. Look at the number of times I had to roll this contract to save the 100 shares. By the way, I have more than 100 Google shares, but given the future prospect of Google, I do not want to lose these 100 shares that I have gotten at $100 cost price. That's a very good entry price. I mean, look at where is Google now, 150s, 160s. I am sitting on a nice 5,000 to 6,000 profit, and I believe there is more upside to come. As a result, I have been rolling this call contract. During the process, I managed to roll up the strike price from $100 to $130, which means if this 100 Google shares get caught away anytime right now at $130 strike price, my capital gain would be $3,000 because my cost price was only $100 per share. But I don't want that to happen because I will lose out on more upside. Furthermore, if this 100 shares get caught away, the odds of me getting back the shares at $100 again is quite low, unless we have a huge market crash again. Alright, in case you don't get what I am trying to bring across, basically, as you can see, I was okay to let go of Bank of America shares, but I'm not okay to let go of my Google shares because I need them for my long-term portfolio. There you have it. This is the first hack. Apply whale strategy on good companies that you are willing to part ways. It can be a solid company that already has a very heavy weightage in your portfolio and you are willing to trim some of your positions. Or it can also be a good company where its share price is very volatile and you know it will decline enough for you to pick them up again at a cheaper price. To be really honest, if I had a lot more Google shares in my portfolio, then I may not mind allowing these 100 shares to be caught away. In short, look at the weightage of the stocks in your portfolio. Then ask yourself, which stock and how many shares are you willing to part ways? Don't be like me, keep rolling and rolling, which will naturally affect your win rate and profits. Moving on, the second rare hack is implied volatility, or in short, IV, which can really affect your profits by a lot. Well, I'm sure there are others who talk about what is IV, what's IV crush, expected move, what causes IV to spike or drop, etc, etc. But I think there are very few out there who actually emphasize how much difference can IV make in your profits and premiums with the help of real examples. And so that's what I am going to share right now. First of all, in case you're not aware, I have been keeping track of my options real trades in an Excel file, but unfortunately it was only in August 2023 then I started to record down the IV of each trade that I made. So what I observed is that IV really can make a difference in my profits and also the amount of risk I need to undertake. For instance, check out this trade. It's a cash secure put on Tesla sold on 8 December 2023 and was set to expire on 12 January 2024. The total days to expiration, or in short, DTE, was 35 days. The strike price was $205. At that point, Tesla was trading at around $240. So this means Tesla has to drop around 14.6% to breach my strike price. The premium collected for this trade was $215. Then check out this trade, another cash secured put on Tesla. This put was sold on 27 September 2023 and was set to expire on 3rd November 2023. The DTE was 37 days, the strike price was $195. At that point, Tesla was trading at around $241. So this means Tesla has to drop around 19% to breach my strike price. The premium collected was $290, much more than the first trade. Well, what does these two trades mean then? Let's put them together and break it down. So, on both occasions, Tesla was trading at roughly the same price, about $240. As for the DTEs, both trades were pretty close as well, at 35 and 37 days. For the first trade, Tesla has to fall 14.6% to breach my strike price, while for the second trade, I had more buffer because Tesla has to drop more, or 19% to be specific, to breach my strike price. This also means the second trade is, in a way, slightly safer than the first one, so to speak. And here's the catch, the second trade that offered me a bigger margin of safety also gave me more premium. I mean, shouldn't I receive more premium when the trade is less out of the money or closer to the strike price? Okay, to put it in even more simple terms, if the strike price is closer to the current trading price, the risk of the strike price getting breached is higher, and by right, I should get more premium for taking on more risk, which is the case of the first trade. So why is this the opposite? Well, it's because of the IV. The difference in IV is huge for these two trades. The first trade had an IV of 47.6%, while the second trade had an IV of 60%. This is why even when I had more margin of safety at 19% for the second trade, I still collected a higher premium of $290 as compared to the first trade when the buffer was only 14.6%, and yet I got a lower premium at $215. Anyway, just for your information, both trades expired worthless and I got to keep both full premiums without having to close my positions. Okay, very quickly, here's another example. These are two different cash secure puts on Google. One was sold on 6 December 2023, while the other one was sold on 21st September 2023. On both occasions, Google was trading at around 130, and the DTEs were also almost the same. For the first trade, my strike price was $125, which means the trading price of 130 is very close to my strike price, which also means there is a high risk that my strike price will get breached anytime because Google only needed to fall 3.8% to hit 125. And for this trade, the premium that I received was $150. On the other hand, the second trade has a lower strike price of 120, which gave me more buffer because at 130, Google has to drop 7.7% in order to breach my strike price of 120. This is double the buffer or margin of safety when you compare it with the first trade. And yet, the premium received for this trade is roughly the same or slightly higher at 152. In other words, for the same premium received, my risk is actually lower for this second trade. So, a look at the IV, you will understand why. The IV for the first riskier trade was 23.65%, while the second one was 34.82%. It's quite a big difference. Okay, I hope these examples are useful in helping you to understand how IV can really affect both your profits and the risks that you need to undertake. Because when the IV is low, it means you need to choose a strike price that is closer to the trading price in order to have decent premiums. If not, you have to sacrifice some premiums to choose a further away strike price in order to reduce the risk of your strike price getting breached. And in contrast, when the IV is high and when there's extreme volatility in the market, that's when you can have more buffer in selecting your strike price, thus lowering your risk of assignment, while at the same time collect decent premiums. All in all, when one is presented with a high IV environment or when one thinks that the IV is overstated, that's the time to ride the IV wave to your advantage through options wheel strategy, because options are more expensive under such circumstances. And as an options wheel trader, you sell options, and that is to your advantage. You basically want to sell expensive options to collect decent premiums, and that's how you maximize your profits. Alright, moving on to the last hack. This is my personal favorite and it's one that I believe probably no one or maybe very few have talked about. But before that, can I call for your support please? If you have learned something so far or would like to see more of such videos on options wheel strategy, please help to like, subscribe, share and comment something below. Also, if it's within your financial means, do consider buying me super thanks on YouTube or a cup of coffee via my Ko-Fi link for the efforts put in this video. Okay, back to business. The last and definitely not the least hack is take advantage of overreaction in the market. Not sure if you realize in the short term, the stock market is very driven by emotions, news, noises, and knee-jerk reactions. And usually after the market had overreacted to one direction, it will likely resume back to normal, which is the opposite direction. Well, it may not always happen, but it does happen quite often. Therefore, if you are able to spot such scenarios in the market, it can really increase your win rate. Let's use some real-life examples to explain this. Personally, I have seen quite a number of such events in the last 2 years, but let's just look at 2024 alone. The first example, Apple. At the start of this year, okay, to be more precise, just 4 days into 2024, Apple had 2 downgrades from Barclays and Piper Sandler. The reasons given were concerns of slowing iPhone sales in China and the potential regulatory headwinds such as the ongoing Apple Watch patent controversy and antitrust fights. As a result, check out this chart. Apple had 2 gap downs in 4 days and the share price plunged about 5% in 4 days as well. Just like that, Apple lost more than 160 billion of market value. To me, that was overreaction by the market. It didn't warrant such a huge drop, to be honest. Just to add on, the sell-off had brought the RSI to a super oversold level. It was a level that Apple only hit 4 times in the last 10 to 11 years, in 2021, 2018, 2016 and 2013, so it was due for a bounce in the near term. And therefore, I sold 2 cash secure puts that week on 2nd and 5th January, with both expiring in February, and the strike prices were 170 and 175. Well, if you have been following my weekly videos, you will know that I rarely sold 2 puts on the same stock in a single week. So when I decided to double down on this trade, it simply means I was quite confident that the market had overreacted to the downside by too much. And I was basically anticipating a bounce. For more information about this trade, please check out the video at the top. And so, true enough, the following week, Apple started to rebound, and with a blink of an eye, Apple went back to the level before it gapped down at around 192. In fact, at one point, it went even higher by hitting 196. Anyway, Apple stayed above 180 all the way to end February, and therefore my 170 and 175 strike prices were never breached in the process, and I got to keep the full premiums for both trades, which adds up to around $360. Here's the next example. It's this cash secure put on Google that was sold on 1st March 2024. Once again, the market had overreacted. So what happened was on 26 February, Google's generative AI tool Gemini made some blunder. Because of that, the stock fell 4.4%, losing $90 billion of market value in just one day. Well, it's kinda obvious that this was an overreaction, right? I mean, nothing much of Google's fundamentals have changed. It was just a bit of a blunder or blooper, as it appeared to me it was a rush product by Google in attempt to rival Microsoft AI tools. I don't think it warrants a $90 billion drop in market value. It's not like they miss earnings by the big mile or what. So anyway, I waited for the dust to settle a little bit and basically sold a cash secure put on 1st March with a strike price of 130 expiring 12 April. For more information about this trade, please check out the link at the top. Anyway, after I sold the contract, Google went super close to my strike price, but it bottomed out at 130.66. From there, the share price went on a monster run and even hit a few all-time highs along the way. And then on 12 April, the expiration date, Google closed above 150 and the contract expired worthless, which means I got to keep the full premium of 155 without having to close my position. Okay, in case you think this hack only works on overreaction to the downside, let me show you another example. It's this covered call on Tesla. So what happened was on 26 March, Elon Musk announced that Tesla would offer a 1-month free trial of their full self-driving system, also known as FSD in short, to their car owners. The market perceived this as a vote of confidence from Elon Musk on their latest FSD updates. As a result, Tesla jumped and gapped up when the market opened. At one point, it was up more than 6.5%. At that moment, I knew it was clearly an overreaction by the market, and such overreaction surge in the stock price is not sustainable. Therefore, I took the opportunity to sell a covered call with a strike price of $200. For more information about this trade, you can check out the video link at the top. Anyway, true enough, the euphoria died down shortly after, and Tesla continued its downtrend and plummeted to as low as 139. And fast forward to 3rd May, the expiration date of the covered call, Tesla closed below my strike price and the contract expired worthless. Once again, I got to keep the full premium, which was a decent $600. Okay, another example. Pardon me if I am showing too many examples because I don't want to be just sharing the theories, which I think you can find all this all over the internet, YouTube, TikTok, etc. I mean, I thought it will be more beneficial if I could show how these hacks can be applied to real trades. And of course, there will be more of such examples in the future, therefore please stay subscribed if you haven't. Anyway, the next example is also a covered call on Tesla. This contract was sold on 29 April with a strike price of $200, set to expire on 7 June 2024. So what happened was on 29 April, it was reported in the news that Elon Musk has visited China, where Tesla got a tentative approval on their full self-driving. And on that day, Tesla gapped up and popped 15% in one day, even better than the earlier example. In fact, this was Tesla's biggest one-day jump in 4 years since February 2020. In the process, Tesla added roughly $82 billion to its market value. How can this not be an overreaction by the market, right? Just to add on, Tesla already had a gap up the previous week after it reported its earnings. This means Tesla has jumped from around 144 to 194 in 1 week, and that's a 34% pop. I mean, how sustainable can this be, right? In short, I knew the market was overreacting, and therefore I immediately sold a cover call on the day when it jumped 15% and received a very good premium of $900. The strike price was $200 and set to expire on 7 June. And guess what? Right after the 15% pop, it was followed by 4 red candles, and my trade was sitting on a nice profit within the same week. Okay, if you have stuck around till this point, thank you very much. Here's a bonus tip to increase the winning rate for this overreaction hack. Basically, this hack is particularly more profitable if the direction of the overreaction is the opposite of its main direction or main trend. What do I mean by that? Using back the earlier examples. First, check out Apple. Apple was on this nice uptrend that stretched from October 2023 to the end of 2023. Or if you were to zoom out a little bit more, you can see that it is on this super long uptrend since it bottomed out in January 2023 and exited the bear market. Basically, either ways, it is showing us that Apple's main trend is up. And the overreaction by the market was down after Apple received 2 downgrades, which was against the main trend. When this happens, there is a high probability that buyers will step in to sweep up some shares, and the share price could either have a short-term bounce or just go sideways, which it did, at least for the next few weeks. Next, check out Google's chart. Similar to Apple, Google has been on this uptrend since October 2023. In fact, its chart was more bullish than Apple, as the uptrend was very much intact all the way to February 2024 before it had that AI blunder. And when the blunder happened, the market overreacted by selling off, and therefore the overreaction trend in this case is down, which is a counter trend of the main trend, which was up. When this happened, once again there was a high chance that buyers will step in and the main trend will take over soon. And it did. As you can see from the chart, despite Google continued to fall a little bit more after that blunder on 26 February, it rebounded in early March. And the rest is history. Finally, check out Tesla. I think you don't need a rocket scientist to tell you that Tesla is on this super long-term downtrend that started way back in July 2023. So the main trend was down. And during the both incidents of overreactions, the share price popped, which means the overreaction trend was up, and it was opposite of the main trend, which was down. As such, we can expect sellers to step in, and there was a high probability for Tesla to retrace back on both occasions, because the main downtrend will likely take over control, and it happened, as you can see from the chart. Alright, that's all for this video. Comment down below if you would love to see more of such videos. More importantly, I hope this video has been useful for new options wheel traders out there. And do help me tap the like and subscribe buttons if you haven't, and comment something down below. Thank you very much.